Let's look at the role of mutual funds in building a balanced investment strategy. The role of mutual funds, if your desire is to build a balanced investment strategy, you need to consider number one, diversification across asset classes. Diversification across different asset classes. So mutual funds allow investors to diversify their portfolios across multiple asset classes such as bonds, stocks, and cash equivalents, which help to eventually reduce risk. So in this case, you have uh, different kind of uh, different types of funds you could utilize. You may use equity fund, you may use bond funds, and you may equally decide to use balance funds. So balance funds incorporates both equities and bonds in the portfolio. Bond funds tends to specialize essentially on bonds, while equity funds concentrates in the stock market. They concentrate on the stock market. Number two is on risk management. So when we want to talk about risk management, we consider the fact that it is a balanced strategy aimed to manage risks by investing in a mix of asset classes that perform differently in various market conditions. So there tends to be little correlation between them, and they perform differently. They don't really correlate in different market conditions. So if you talk about equity, when you incorporate equity into your portfolio mix, you know it may be it can be volatile, in a certain market condition, but it offers higher returns, in the long term. If you equally make do with bonds, you discover that it offers income and stability, which can offset, market decline. In the case where there's a market decline in stocks, then the bond aspect of your portfolio could then perform excellently. So mutual funds automatically achieve this balance by investing in a variety of securities within each funds. Number three is professional management. So mutual funds are managed by professional fund managers who make decisions about asset allocation, about investment selection, and also may incorporate market timing. So this management helps ensure that the fund remains aligned with your investment goals. That's alignment with your overall investment objectives. So in this case, you may consider active funds, or you may also do with passive funds. When it comes to active funds, actively managed funds can adjust holding based on the market conditions to optimize returns, while index funds provide a broad market exposure and follow a passive strategy, often with lower fees. It's a low-cost strategy anyway. Number four is cost-effective diversification. Cost-effective diversification. So mutual funds provides instant diversification, which will be difficult to achieve, individually, especially for a small beginner investor. Instead of purchasing multiple securities, you can achieve a broad exposure with a single investment. Instead of picking individual stocks here and there, you can just buy an equity fund that have many stocks in its portfolio. So number five is rebalancing made easy. Rebalancing is made easy when you invest in mutual funds. So mutual funds automatically rebalances their portfolios as needed. They do it regularly. Wherever the need arises, they rebalance their portfolios. This ensures that your desired asset allocation remains it remains intact, without requiring you to actively manage each individual investment. Your fund managers will do that for you, actually. So you are saved from the hassle of having to manage your investment yourself, considering the fact that you may not really have sufficient skills and experience to obtain better results. So the fund manager will help you to achieve that. A typical example is a balanced fund that maintains a 60-40 stock bond allocation, while automatically, adjusting stock outperformance. Whenever there's whenever stocks outperform bonds, they will increase the allocation of your capital on stocks. And if bonds outperform stocks, they will increase the capital allocation on bonds, and vice versa. So they adjust it, 60-40, depending on which particular asset, class performs better. Please subscribe to this channel and like this video if you've not done that. Number 6 is tailored for different risk profile. These mutual funds are designed to accommodate different individual risk profiles. So they are tailored for different risk profiles. Mutual funds are available in a wide variety of risk level, from conservative, bond funds to aggressive growth equity funds. So you now make a choice depending on the level of risk you are able to stomach, you are able to bear. And so this allows investors to choose funds that match their risk tolerance and investment goals. You don't make a choice based on what you are able to tolerate and your overall investment objectives. And so in this case, you have target date funds, which automatically adjust risk as you approach your retirement target date, offering a more conservative approach over time. So target date fund is a typical example of a strategy that adopts, that mirrors individual risk profile. Just like I earlier gave example of our pension fund administrators and allocation to different asset classes depending on our age. Number 7 is liquidity and flexibility. Liquidity and flexibility. Mutual funds are highly liquid, meaning you can buy or sell at any time, making them a flexible option for investors. They don't really suffer illiquidity. This liquidity allows you to adjust your strategy based on changes in financial goals or market conditions. So you can very easily make adjustments here and there, in response to market condition, or maybe there's a change in your investment objectives. Number 8 is accessibility for all investors. Everybody with capital, no matter how small, should be able to invest in mutual funds. Mutual funds offer a cost-effective way for small investors to access a diversified portfolio that would otherwise be difficult to assemble. By pooling funds from many investors, mutual funds provides access to large-scale investments with relatively low minimum investment requirements. So they pool funds from different investors, and then it's accessible actually. Virtually anybody and everybody can invest in a mutual fund. So in conclusion, mutual funds play a crucial role in a balanced investment strategy by providing diversification, professional management, risk mitigation, and easy access to different asset classes. They allow investors to build and a portfolio tailored to their goal, risk tolerance as well as some time horizon. And so all while at the same time, reducing the complexity of managing individual securities. So that's the joy of investing in using mutual funds uh, to build a balanced investment strategy, because of the fact that they invest in different asset classes. You discover that you can achieve a balanced kind of investment strategy actually.